Good morning, guys. Today is January 18th, Thursday, 10 o'clock local time here in Seattle. Hope everybody is well. Markets, I think one of the big stories that I'm continuing to talk about for the year 2024, at least the first couple of weeks or so, is how much cash is still on the sidelines in the market. $6 trillion, according to Bank of America. Now, a lot of the cash is in money market accounts. Some of it is in long-term CDs, certificates of deposit. So they may not come initially to the market quickly, but every dip in the market seems to be getting bought up. What would have normally been a slow ride down to at least a dip or a pullback or a correction to about 6, 7, 7, 10% is now getting eaten up. So one bad day in the NASDAQ or the S&P 500, the next day it goes right back up. Even the days when it is lower, the market seems to be catching up towards the end of the trading day to move higher. So that's the interesting part of the story for 2024 so far. We'll see how the rest of the quarter goes. One of the companies that showed up on the radar consistently that will continue to do well is ServiceNow. I wanted to talk a little bit about the company, its background, what it does, and to give you a little bit of context on this one. In 2001 to 2006, about 4 or 5 years, I worked at a company called Mercury Interactive, which was then acquired by HP. So we were part of the HP software universe, which is now part of HP Enterprise. And the company made solutions for IT organizations. They started in the quality assurance space, selling Windrunner, LoadRunner, products like those to ensure that QA people did their jobs better. Then they started building products for monitoring products, applications that were built by IT organizations to see if they were available, they were performing. So availability and performance, and also diagnosing root cause problems were a big issue at that point in time, still is. Now that space, which was called monitoring and application management, is now called observability, with a little bit of a twist. It's not the apples to apples comparison. Previously, that was primarily sold to organizations in IT infrastructure and operations. Now observability is also being used by developers for doing DevOps, if you will. So monitoring how the application does pre-production and also in production, more of a developer job as well right now, as opposed to purely a production operations job. Okay, the context is important to tell you that is because ServiceNow operates in the IT service management space. So let me give you a little bit of more context about that. That's how they started. They've evolved dramatically from there, obviously. ServiceNow started in the IT service management space. Essentially, if you look at IT organizations, they have to take requests, they build projects out, they build applications, they manage those applications. Some of those applications are used by everybody in the employee's base, for example, email and file sharing, etc. Or some of them are used by customers, such as websites and e-commerce sites, etc. And what ServiceNow does is manage one part of it, which is service delivery and service support, allowing people to be able to send requests, manage those requests, see the resolution of those requests, manage IT projects overall, if you will. That's what ServiceNow started as. Now they've changed dramatically, and they're not just trying to sell to IT organizations, they're also trying to sell to the other business teams to be able to manage inbound requests, build applications on top, etc. Very, very interesting company. Previously, Frank Slootman, who now is the CEO of Snowflake, was the CEO of ServiceNow. Took them from a very small company to right now they're on a run rate of about $7.78 billion in revenue, and they're looking to nearly more than double that in the next 3 to 5 years. So let's talk about ServiceNow. Very good company in the IT space, growing very well, good challenger in the space for IT service management, and likely one of the good SaaS winners. There are quite a few of them in the B2B SaaS area, such as Workday, which operates in the HR space. ServiceNow operates in the ITSM space, and then Salesforce operates in the CRM space. But they're all trying to, move into each other's space. So keep that in mind as we go along. All right, what does ServiceNow do? So let's assume you're an organization, a large one, for example, such as Pepsi, and you have a lot of different teams all working in different projects on different organizations worldwide, and you want to be able to manage all of these projects. You want to be able to go ahead and take care of support requests. For example, if someone's lost a password, someone's computer is not working, those are one type of IT requests. Another one are more application requests. Hey, my app is very slow. How can you fix it? So what they started doing was essentially allowing people to be able to do that. They've got about 7,700 global customers. 85% is of Fortune 500, as you can see in this one. And they use, initially they started as an app, more of an IT service management platform app, specifically taking care of requests. To give you context, back in the 2000s, when I was in the space, BMC, which is a software company now private, and Tivoli, which was from IBM, HP Service Desk, Remedy, which was then bought by BMC, were the companies that used to operate in the space. Siebel also had a customer service support ITSM product, help desk service desk kind of a product. Now, of course, the platform has fragmented quite a bit. So that's what ServiceNow did, and they want to be one of the most important companies in the enterprise software space. So what is the problem at a very high level? At the very highest level, you will hear a lot of CIOs saying IT organizations seem to be doing what they're doing without a lot of connection back into the business team. So there's always a push from CIOs and CEOs in particular to make IT work with the business a lot more closely. So the CEO, sorry, saying, okay, I've got the CFO, COO, they're all selling, finance, managing all of those different applications, or sorry, different pieces of work. The IT organization supports them, but they seem to be doing a lot of stuff, which is what a lot of industry people call KTLO, keep the lights on. They're just having applications that are running, not adding innovation, not providing a lot of apps. So they're always, CEOs always wary about having IT do their own separate thing away from what the business needs. So that's one of the biggest challenges CEOs worry about, spending a lot of money on IT. To give you context, IT organization spend can be the number 2 or number 3 in any organization. Number 1 usually tends to be marketing spend for most organizations, between 12 to about 14% of total revenues. IT spend can be anywhere at the low end 4% to anywhere in the high end about 15%. 15% may be a little bit too much, 12%. Gartner says it's about 12 to 15%, but I'd say most organizations is between 4 and 8%, the average being about 7%. And now, of course, in the high end, as I mentioned, 12 to 15% is also normal. So if you're spending that much money on IT, applications, computers, phones, everything goes into IT, right? Website, mobile phones, security, all of that needs to be aligned with where the business wants to be able to grow. So Service Desk went from a $2 billion revenue run rate to an $8 billion almost run rate basis on an annualized basis, of course. They've grown phenomenally. They're completely subscription basis, software as a service solution, hosted on the cloud, managed very easily, operating margin of about 26%, and a very good free cash flow margin as well as about 30%. So strong financials, executed very, very well. Now, as I mentioned, initially, ServiceNow started as an IT service desk, primarily catering on the left-hand side of the spectrum. We look at this, the SVP of IT or the CIO. Then they slowly started adding more applications, and the platform was made broader to be able to support the HR organization, the security organization, the chief customer support organization, the technology organization, and so on and so forth. So they've slowly added applications that help them move across the board to a lot of different organizations as well. So rather than just be an IT thing, now the entire enterprise can build applications on top, new applications, because they provide ways to be able to have no code solutions on top of their platform. It makes it a lot more easier. So the point is, ServiceNow has evolved from being just an IT organization application to now across the enterprise application. And a lot of large companies are starting to build on top of this internal applications, not so much external, but a lot of internal applications, employee-facing applications, supplier-facing applications, maybe to a certain extent, and also internal use applications for being able to grow the enterprise thing. So what does the platform actually do? This is what their platform does. At the bottom, ServiceNow Cloud, everything is provided by, and they provision on their own. They have about 34, I think, 34 different locations, data centers. Some of it is on cloud, on their own, on what they would call on-prem, and some of them is cloud-based, public cloud, which is AWS and Azure, etc. On top of that, they built a data model that allows you to, and the CMDB is Configuration Management Database. Again, back to the ITSM. The ITSM world has specific names and specific terminologies. Each of these are used for specific things. Again, CMDB, back to the old IT world, where every portion of every application, asset, software was tagged and kept into the Configuration Management Database. CMDB was what you wanted to be able to have so that you can understand what everything is available for IT. And then top of that, they built a bunch of platform applications, capabilities that allowed people to be able to have workflows put in place. So let me give you an example. Let's say that you have a HR person and there's a new employee onboarding workflow. So the first thing they have to do is they have to be given a badge. Then they have to be able to go ahead and get a machine. Then they have to go ahead and get training. So that entire workflow can be managed, modeled, developed, and provisioned on the ServiceNow ServiceNow platform, if you will, completely custom for a specific company. Can be done, not a whole lot of it, but quite a lot of it can be done by people that are not programmers. They've added on capabilities consistently. So, for example, you see RPA, robotic process automation. This is one part of it is a competitor to UiPath. And they've integrated with about 300 different companies. So they've provided a lot of platform capabilities to allow, when someone says platform, that means it's focused on developers. Makes sense? It's not just applications. Applications are end users. Platform tends to be more developers. But in this case, the developers for this platform can be hardcore app developers and technical folks, or it could be even low code, no code folks. So each of these allows you to be able to have specific applications on top. So if technology workflows, for example, IT service management or operations management, asset management, etc., these are the ones that they started out with. And now they're slowly building out the complete list for non-IT work as well. As I said, all the way to the right-hand side, App Engine, they have low code. They acquired a company, by the way, which is how they got the low code, no code kind of a capability. And they're building industry-specific solutions in the 5 industries that they are most prevalent in, and they want to be able to get more traction with: telecom, technology, financial services, manufacturing, healthcare, and public sector. So they seem to be moving more in that direction. So there are lots of other, when they say creative workflows, what they mean is there are a lot of other non-IT workflows that they're getting a lot more traction with. So let me just summarize here what we've learned so far. Software as a service company, they've gone to now about $8 billion run rate basis. They're about 2 billion last quarter, so they should be able to get to, they're not exactly at 2 billion for an annualized basis, 7.7, but they'll get there. They're looking to get to about 20 billion by 2027. So the growth is on their side. The company is richly valued, very strong financial performance, both on the top line, 70, 80% margins gross, and then 26%, 24% net margins, very strong growth. They've moved away from just their core base of IT service applications and platform to a platform that allows you to be able to manage your applications and workflows across the entire enterprise. So that's what we know about this company so far. Very strong presence. They're not so very well known outside of the technology world, only because they tend to, I'm sure a lot of people who are investors would know about them, but they tend to focus more on the IT organizations, B2B, so not a lot of people know them, unlike Salesforce, which has one of those founders, and Mark Benioff, who just goes out and tells everybody the story about the world, right? Okay, so when customers leverage the platform, they can manage their entire system within the platform itself. Again, CMDB is a very specific term. It's primarily used for ITSM, but outside of that, you can keep all of your data, think of it that way, in one specific place. You can discover your assets and you can tag them. There's automated discovery capabilities as well, or you might just log in. Every time something comes in, you will scan it, you'll put a barcode on it, or you might just enter and say, now I have a new system, I have a new server, I have a new network system, I have a new PC, I have a new mobile. You just put all of that into one place, manage the asset for patching, for servicing, for account delivery, for managing your ongoing financial accounting with it, etc. And then they allow you through the platform, and they allow their customers in the platform to be able to manage all of those different elements of what is needed for an application. So if you have a lot of internal applications, you can actually build it on top of the ServiceNow platform. They've done a lot of acquisitions, roughly about 20 acquisitions or so. I'm not going to go through every one of them, but I can tell you that most of these actually, IntelliBot example, RPA 2021, is robotic process automation. What they allow you to be able to do with these is to be able to expand the platform with capabilities that allow people to expand their TAM, their total addressable market, right? And so they've done about 20 or so, 15 to 20 different acquisitions over the years, bought small little tuck-in companies that allow them to be able to expand the platform. So they've done a good job so far. If you look at the financials, from roughly about 400 million in revenue 2013 all the way to 7.2 billion 2022, 7.7 billion 2023, trailing 12 months is 7.7, next 12 months is about 8 billion. That's where they're going in terms of revenue. Gross profit in the 80%, almost 78% range. It's been moving higher, not lower. And then net margins, operating margins in the, if you saw that, it's 4%, but operating margins now, EPS earnings growth, it's been terrific. We'll get to that in a little bit more when we go through a 5-step process. So where are the expansion opportunities? Now that they have 8 billion, how big could this get is the question that a lot of people ask. They have a good footprint in US, in the Americas, as they call it, with about 65% of their business coming from Americas. EMEA and APAC are where the growth opportunities are. There's a lot of growth opportunities in the industry-specific areas, financial services and telco. They have a good amount of money coming from there, about 31%, but they can grow more there. They're also going after a segment coverage from the marquee top enterprises all the way to commercial and non-profit. So they're trying to make sure that they can be as many different segments as possible. Although government should have been there, I don't know, for one reason, they seem to have not done that. There are about 2,000 different partners, over 1 million people that have been trained on ServiceNow that can help you be able to build your applications out, manage it, deploy it globally, or deploy it within your enterprise. That's where the opportunities for growth come for ServiceNow. About $220 billion is being spent, according to them, currently on applications and platforms to be able to manage applications within the enterprise for different technology workflows within the organization, or employee workflows, or industry-specific workflows, and other new workflows. The bigger one that they're going after now seems to be in the creator or other workflows, which is non-technology related. So their trajectory growth, they're expecting to get to 20 billion by 2027. So how will that happen is a question that I get a lot of people asking me, from 8 billion to 20 billion. So let's assume they're right now roughly about $100 billion or so, a little more than that, obviously, in market capitalization. So if they're doing 8 billion in revenue, 78% gross margins, and 100 billion or so in market cap, you can very quickly see this is 11 times price to sales. So that's 8 billion getting to 20 billion will give you about 2.5, something like that, in terms of growth. Can this get to 200 billion or even more? It absolutely can. Think of it very similar to how CRM was. But CRM, which is Salesforce.com, had done it over 21 years. This company is a little bit younger, but they're on the same trajectory. Make sense? Okay, so they have a lot of different customers. They're continuing to add big, large, mega customers, marquee brand names from BASF and Dropbox, which is a smaller business, but still a public company. And they've done a very good job of expanding beyond their large only IT customer base to people that are across the board in very different areas. The big story for them in 2023 was how they leveraged, and they did a partnership with NVIDIA as well, how they can leverage generative AI to help users. And they've got specific use cases for in many of their personas, whether it's the developer persona within who develops on top of ServiceNow, all the way to the employees that want to build a specific workflow that automates a specific task that they might have, but not have to use a developer to do it, and instead can do it within a low code, no code kind of a situation, and everybody else in between. So when you look at a developer, it just makes it, they want to make it faster, easier, and quicker to develop applications and customize with as little expertise as possible. And then all the way to the right end of the spectrum, employee as a persona wants to be able to do it with no code, so they don't have to keep asking for a developer to do something. Again, for them, the value of the platform increases. And there are other specific personas within the organization inside that make it easy for them to use Gen AI. And what their claim is that every one of these personas, for every one of the different workflows they have, will be able to use and leverage generative AI capabilities to reduce their overall cost, have higher productivity, and use more capabilities of the platform with fewer people. So that's one of the big things that they're pushing for 2024 and beyond, which is from a platform perspective, how can they start to get to that 20 billion run rate, right? They still see a lot of opportunity. As I said, about 65% of the revenue comes from the US and the North Americas. 25% comes from UK. That I suspect will get to closer to the 30%, is one big push for them. And then IPAC, which is 10%, typically will get to about 15%. Of course, at that point in time, Americas will drop a little bit more. So this goes to 15%, this goes to 30%, that should drop to about 50%, which is a balanced enterprise B2B kind of a revenue by segment, by region split that I would expect from someone like ServiceNow. They have a fairly large ecosystem of partnerships, very similar to yesterday when we were talking about it. I talked about Nutanix as well, a very partner-driven model. ServiceNow is more of a direct company, meaning that they have their own sales force talking directly to end customers, less dependence on partnerships, but they do have a lot of 2,000 plus partners in various different areas, whether they are partners who can help you develop, deploy, customize, manage, and configure ServiceNow to people that you can run ServiceNow on top of. Roughly about 1 million plus people run and manage and have been trained to manage the ServiceNow application administrators, everybody else. The stock has done fairly well over a 5-year time frame, nearly up 300%. So it's 3x in the last 5 years, almost 3x. The last 1 year, it's gone up about 75%. Extremely strong performance, better than the market, about 54%. And all time, it's gone up 30 times. Really good performance. ServiceNow, if you had bought into the IPO 2016, you're sitting in Fat City right now. Very, very nice, consistent movement. I expect that the company will stock split sometime in the, I don't know when exactly, it's hard to say, but sometime in 2024, when it gets 1,000, you might see a 20:1 stock split, which might get it to the $50, much more affordable price, even though the market cap would still be fairly high. But at $1,000, it gets very unwieldy. Look at the other companies, Apple. You look at Amazon, about the $1,000 range. They said, okay, all right, we're going to split it down 50:1, and that gives you the ability to be able to help more people buy the stock, if you will, not 50:1, at least 40:1. Market cap at 151 billion, sorry, not 100 billion, $151 billion. So that's very, very large. That means their price to sales is extremely high. Not bad, but it's extremely high. Just keep in mind, because they're growing, but still at $151 billion, doing about 8 billion, you can see it's nearly 20 times price to sales for a company. Well, the earnings is growing very fast. So the price to EP ratio of 94 is still high, but since they're growing fast, you can give it a little bit of room. But my suspicion is it's probably going to move a little bit in the moving averages zone. So wait for that if you're interested in buying it immediately. Roughly about 20,000 employees, so doing fairly well. Moves from and from the market. So if the market moves down up 1%, this goes up 1.5%. Markets move down 1%, this goes up 1.49%. Okay, roughly subscription revenue only versus services revenue. Consulting revenue is about 6.8 billion. Operating margin of about 26%, fairly well. Lots of good free cash flow. They've done an extremely good job of being able to grow the business in a very financially smart, savvy way. This is just a summary, what we've learned so far, right? So the no layoffs, I think they'll probably change that a little bit when they get a little bit more of a tough challenge. But not for right now, I'm not going to move that. They've done a good job of being able to move from where they were to where they are at this point in time. Strong growth, good CAGR in terms of subscription revenue. And even though it's gone from 38% down to 29%, they continue to move the ball forward. Good backlog, which means that their remaining performance obligations, RPA, which is stuff they've already sold, but they have to be able to recognize revenue for, which means a lot of it is in the bank, is also a good way to look at this. Customers expand. So once customer buys into the IT service management solution, ServiceNow, then the next step usually will become that they want to be able to go ahead and manage it beyond that point of time and expand the base. They have a large customer growth. Spend has been consistent with them. Literally over 1,600 customers spending more than $1 million a year. Annual contract value is ACV, and 20% of them are their large customers. Only 20% of their 20% of their customers are $1 million plus. Just look at this: 40 customers are spending more than 20 million a year. This is as enterprise software as it gets. So even though they have 1,600 customers spending more than $1 million, it's only about 20% of their total ACV. The way you want to think about enterprise software companies is enterprise software tends to be lumpy. What that means is a few customers might dramatically change towards the end of the quarter if things get difficult, might change the quarter's performance in terms of quarterly revenues. This 20% is still okay, but just keep that in mind. That typically is my experience. When you have an enterprise software company, a lot of the big customers, if they want to get a little bit of a better discount or things slip because of some reason, that tends to affect the stock quite a bit. That's one of the risks with ServiceNow. In terms of guidance for the year, they're going to go estimated 8.5 billion in subscription revenue, move their performance applications to about $7 billion and $2 billion in free cash flow. Their goal is to get to 15 billion in subscription revenue by 2026. And I remember I mentioned $20 billion in bookings overall. Very profitable. Operating margin, long-term profitability expecting to be in the 28%, free cash flow margin in the 31%. So good financial performance. One of the other ones, which is a challenge for them, besides the lumpiness of revenue, which might be a challenge, is their share-based compensation, stock-based compensation. It's nearly 20% of their revenue right now. It's gone down a little bit from 19, 20% down to about 17, 18%. Actually, the last quarter was 18%, but their goal should be to drive to 10%. That's what a lot of companies have been saying. If you remember Nutanix yesterday, I mentioned the same thing. Stock-based compensation being 20% of your revenue. I mean, just imagine someone like this, someone like ServiceNow doing $8 billion, they're getting nearly $1.6 to $2 billion in just stock-based compensation. That's essentially an expense, and that dilutes shareholders like you and I. The customers have grown very, very consistently. Every customer that has been with them before the cohort of 2023 seems to be expanding even further. 205% increase in the actual contract value for customers that started in 2010. So customer cohorts, which is every year that they sign a customer on, they seem to be buying more as the years progress, spending all the way from, you look at that consistency, the first kind of customers might spend about 40%, and then all the way, if they've been around for 10 years or 13 years in this case, they spend nearly 2 times that amount. They're expanding the customer relationships. They've gone from an average of 3.6 million a year to 4.4 million, and they've gone from roughly about 1,200 customers spending over $1 million in 2021 Q3 to almost 1,800 in Q3 of 2023. So roughly about a 30% to 40% increase in 8 quarters. It's a very good move. Most of their, as you would expect with anything else, most of their sales, most of their employees are in sales. Sales typically tends to be about at least 50, in this case, 40%. And then developers tend to be another fairly big base, R&D, which is engineering and so on and so forth. General administration is about 10% of the company overall. That's ServiceNow, just in terms of the background of the company. The next thing that I wanted to be able to do was go through a 5-step process. So let's go through that right now. Let me share that. And for those of you that have known how I go through this, the usual goal is to be able to take the top level view. By the way, the reason also I'm talking about it is because their earnings are coming up in less than 6 days. They've consistently done a good job of managing to earnings, but just make sure that you know about this. If you want to take a trade, you might want to wait. So roughly about 1.3, 1.4 billion 2016, more than 5 times that, 4 to 5 times that in 2022. So very strong revenue growth, grown at 30% consistently, slowed down a little bit in 2022, slowed down even further actually in 2023. Gross margins solid 70%, net margins in the 10% range, 5% range, if you will. That's good growth. That's actually very, very good growth. Balance sheet. Actually, let's go first to the quarterly numbers. The last few quarters, look at that, 20% consistent growth and moving up a little bit. That's what's good. So if you take these 4 quarters, they're at 8.5 billion. They're going to end up 2023 at 8.5 billion, which would be a 25% growth over 2022. Slowed down growth in 2022, picked up back again in 2023. Good move on that side. And now getting to the point of 10% net margins. Look at that. That's very good. Operating margins, as you see, 24, 26% is the guidance, but the net margins about 10% guidance. That's pretty good. All right. Assets-wise, they have enough cash in the bank. Yeah, about 6 billion in cash. And as you can imagine, lots. Okay, that's not too bad. They have non-current assets. Total in long-term investments about 3 billion. So this is a very strong, good balance sheet. They have debt of about 2 billion as well, which is not bad, but must have gotten at a much, much lower rate. Enough cash flow from operations to be able to take care of the business. Valuation is one ding. You're going to get 17 times price to sales for a 25% growth company. Not good, bad, or ugly, guys. Just the way it is. Just to give you context, 13.71 is the average for SaaS companies. The high end of the cohort, someone like look at a Snowflake, or look at a Net, which is Cloudflare, or look at a SentinelOne. They are at extreme other end of the spectrum, nearly 26, 28 times price to sales. But this one, price to earnings is high, but they're growing very well. Earnings are growing very well, so that's not a problem. 78% gross margins, 10% net margins. Nothing to complain about. On a scale of 1 to 10, I'd give this an 8 or a 9. Very strong moves. Okay, so now let's go to a monthly chart first. This would be a beautiful chart. Just look at this. Very nice base build. strong move up. Once they did the markup, this is phase three, this is phase one, all the way up to 2021 November, and then a stage four decline, built a very good base between July of 2020, September 2022 to roughly about February 23. And then since February 23, very strong markup phase, went through right past their all-time high, which was in the 671 range. And now it's 70. So they're at their all-time highs. This is one chart that is beautiful to see. Very strong move. This should be somewhere over here. 700 should be a very good support for it. And resistance, there's no resistance really. This could just keep going up. And earnings would be good. If the market does well, this thing just does well, guys. This is an extremely good, strong company. There's not too many companies that you can see run by a very competent management team. Bill McDermott was previously at SAP. He ran SAP for Americas. Before that, Frank Slootman was the CEO. Very well-run company, very sharp company. I really like this company. I've held it for a long time, so it's not new to me. On the weekly chart, went through this. So this previous resistance should be a support somewhere in the 710 range. This is the weekly chart, so we're still going to get past and see where that goes. I don't see anything dramatically challenging on that. So this is an all-time high on the weekly chart. Again, this is a move up. So this would be one thing to draw, and then this would be another one to draw. Not really something to worry about, if you will. All right, let's go to the daily chart. It's respecting most of the trend lines, so I'm not going to go through that portion of it. Realistically, it's taking a little bit of a break, if you will, overall today, given that it started low and then went higher. But this is, again, okay, on the daily, look at this beautiful move all the way from November, October, all the way up, get a little bit of consolidation. Again, this is a markup stage, consolidation, stage one again, and now stage two markup again. So it's gone through a little bit of a markup phase. You can draw it from here. It could protect and manage this trend line, or it could go a little bit more. So let's look at the personality of the stock on the daily basis. It does tend to come to the 100-day moving average, maybe a little bit more than 100-day moving average. Back in 23 of May, it came down all the way to the 200-day moving average. So that's not going to be necessarily somewhere it comes down to too much. If it gets anywhere in the 682 zone, which is about nearly 20% down from here, which I don't think it will, you should just close your eyes and buy if it gets to 680 ever. But in the absence of that, it hasn't even given you much of a break until it's come in the last few January of this year. Actually, it's not bad. It's come to the 100-day moving average, almost to the 100-day moving average, 680. So it could come to 680. I suspect more than anything else, it's going to touch not the 5-day moving average, but even get to the one below that. It's even stretched beyond the 5-day moving average. That's the challenge. All the moving averages are pointing to the up. This is a very good sign, and it's still not on the other side. This is going up. This is definitely going up, barring a very bad earnings. And the earnings, as I mentioned to you guys, is coming up in a few days. Next week, earnings is on 24th of January. Barring some dramatic change in earnings, which I don't foresee, this is going up. This is going to the 750, 780 range if the market holds, which I think the market will continue to do okay. RSI is very, very strong. It's not in the overbought range yet. The MACD is pointing in the right direction. The moving averages are all okay. This is going up, but it's going to get stretched. This is really stretched on the 5, on the 20, on the 50. Ideally, I'd like it to be able to come back and touch at least so this is the confluence of two different things. The 50-day moving average is in the 700 zone, 706 zone. This isn't going down, but actually the other part of it is we just continue to go a little bit up. The moving averages might move a little bit up and catch up. So you want to buy it somewhere in the 720 kind of a range if it moves down a little bit. But this is a long-term hold. This is not a stock that just dramatically goes up and to the right. It has done a very good job, but this is a long-term hold. This is not a stock you want to be able to worry about. You can do a very good job just holding it for a long time. As you look at it, this thing consolidates sometimes very frequently. And then after the consolidation period, just moves up and to the right. Strong stock, good performance. I really like ServiceNow. There aren't too many things you can find wrong about the stock. Let's look at quickly what the analysts seem to be forecasting, just to get a little bit of a sense. There are about 33 analysts covering the stock. The highest estimate is 860. The lowest estimate is 680. So the lowest estimate is roughly about 25, 30% down from here. And the average estimate is 743. So it's priced at where it is supposed to be. Of the 33 analysts, 29 of them strong buy, 4 of them are buy. Usually anything other than the strong buy is a sell. Just keep that in mind. When they say, okay, we are upgrading it to buy from a hold, 4 of them hold actually. Yeah. So that usually means sell. Okay. So 860 on the high. At 860, the valuation would be even more richer than it is. So this, yeah, at 860, which is roughly $120 from here, which is roughly about 15, more than 15, 25% from here. This would be 25% from here is, what is this, 150 billion? Let's say it's 150 billion right now. So 37 billion, this will get to 185, $190 billion market cap company. At $190 billion market cap company with an $8.5 billion TTM revenue, trailing 12-month revenue, this gets from 15 down to 20s. That's rich valuation for a company growing at 25%. Again, the scale of revenue and the amount of revenue growing 25% year over year is what is giving it a lot of value. So just look at comparables, companies that you might want to look at. So 50, keep those two numbers, 17 and 96. 17 is the price to sales, and 96 is the PE. If you look at Salesforce, just to be able to get comparables, I'm going to do two. The system might be a little bit slow, so I'm not going to be able to do more than two. It just takes too much time. So look at this. Salesforce is at 7 and 100. So PE is high, but the price to sales ratio for Salesforce is reasonable. And you look at it, why Salesforce is so now has better gross margins, but not as good net margins. So their margins, I think there's room for improvement for ServiceNow. And Salesforce, let's look at their growth in terms of revenue. Salesforce is doing a much better job now, by the way, in terms of managing to their costs. They're growing at half that. So now is growing at 25%, 24%, and Salesforce is growing at 11%. And then let's look at another good company in the SaaS space that might be a comparable, not exactly the same, but kind of similar. One of the best-in-class companies. Adobe is a best-in-class software as a service company. You could call them a design company, but they're growing. They're growing well. They're a very strong company. They're valued nearly twice amount, not twice exactly, but about nearly 40%, 50% higher than where ServiceNow is. Adobe is growing at almost, again, half of that, 13%, growing at the same range as Salesforce is growing. And if you look at their PS and PE, so look at this. So this is Adobe's is much better position, half the position in terms of price to sales, 90 versus 50 for Adobe. But the price to sales is fairly high for Adobe, 14 times. So good execution companies that have done a very good job of growing the top line well will get a higher price to sales, which is what you're seeing now with ServiceNow. You could compare them to some of the other smaller companies, but I think these two are sufficient in terms of giving you a good feel for why the company is valued so well and how well it has been doing so far. I like the company. I think it's going to go up. Watch for the earnings in a couple of days and then wait for the flag to develop. It's going to move up a little bit higher. If you can get it at the 500, 700, and sorry, not 500, 700, I wish it was 500. If you can get the 720 kind of a range, if the market pulls back a little bit, or if it pulls down even to the 100-day moving average, just buy a lot of it if you can. The moving averages should move up. So this will move up given how nicely the stock has been moving. This will probably move up to the 700 range. So when it comes down to 700 range, this will be a good buy. Thank you very much for watching. I hope you like the analysis. Let me know what you think, and I appreciate you guys. Subscribe to the channel, and please do comment and let me know what your thoughts are.